Hi students, how are you? Can you hear me? Can you hear me? Okay, thank you very much. I welcome you all in the crash course of SBR paper for December 2025. I'm your tutor. My name is Abu Bakar and I will be taking your class of crash course for SBR. So hopefully you have taken all your classes and you have the idea about the SPR. So without any uh, going into the introduction of the SPR, I will just discuss the strategy which I will be using here for conducting this class of SPR strategic business reporting, dear students. Uh, as you know that in this paper, we have four questions. We will be having four questions. In this paper, and these four questions are divided into two parts. The first one is part A, and there will be 50 marks in part A, and second will be the part B, and it will be consist of 50 marks as well. Now in part A of the exam, the question one will be from group accounts and accounting standards. And this will be consist of 30 marks. Mainly, significant marks would be available for the group accounts, which involves some maybe the discussion on different aspects of the group accounting. And there will be a pre-populated spreadsheet in which they will give us consolidated cash flow or consolidated profit and loss or consolidated balance sheet, and there will be some adjustments which we need to incorporate in that pre-populated spreadsheet, and we have to redraft the correct consolidated financial statement. And along with that, there will be specific accounting issues relating to parent or subsidiaries. That would be in a question number one, and the question number one will be of 30 marks. And the question two will be from, normally it is from ethics and some accounting issues. and this is of 20 marks. This question is of 20 marks. In this question, uh, uh, it will 20 marks, so 8 to 10 marks will be on accounting problem, maybe some case study on an accounting issue like IS 37, IFRS 5, or any accounting standard. It could be IS 19, it could be share-based payment, it could be IS 23 borrowing cost, government grant. Any accounting standard can be tested here in form of the case study. But along with that, there will be some ethical issues revolving around that case study relating to the senior manager and the junior accountant, which we have to discuss in which we have to discuss the accounting issue and the way out of getting out of that ethical dilemmas. Uh, so that will be the question number two, and it would be of 20 marks, 20 marks. So 30 marks in a question number one and 20 marks in a question number two. In that way, we will be having total 50 marks in a part A. In a part B, there will be a question 3 and a question 4. And dear student, each question will be consist of 25 marks. And in these questions, there multiple accounting issues, multiple accounting standards can be tested, or some other specialized areas, which includes alternative performance measurement, which includes sustainability issues, sustainability reporting relating issues can be discussed here. But mainly the accounting standard will be tested here. If we having 50 marks here in part B, 25 marks in a question 3 and 25 marks in a question number 4. Out of these 50 marks, 40 marks will be from the accounting issues, from the accounting standards, and that can be any standard. It could be revenue, it could be cash flow relating issue, it could be relating to 37, IFRS 5, IFRS 16 lease. Anything can be tested here in a question 3 and question 4. But along with that, some specialized area can also be tested here. As I mentioned, sustainability issues, alternative performance measurement, accounting standard for small and medium enterprises. Such things might be tested here along with the accounting standard. So we will be having these 4 questions in part A and part B. And as you know that the format of the question will be in a CB format, in a computer-based format. And in this session, when I will be taking each question one by one, you will be seeing that I will be doing those questions. Mainly, my focus will be that I try to use the real exam format to practice the question and to discuss the accounting issues. But the question will be in a form of paper will be in a form of computer-based exam. Will be in a form of computer-based exam. And I will be using the ACCA practice platform to show you that how we will do the practice the paper question in the exam. But as I told you that we have the 4 questions, question 1, question 2, question 3, and question 4. So we have 4 days. So my strategy will be first I will be doing question number 1 from the past papers, and then after the practicing the question 1, I will be moving towards the question number 2, and then question 3 and question 4. And during the practice session, I will be discussing the accounting standard as well, and the revision of the accounting standard will be taking place as well along with the practice question. So as you know that we have the um, question number one, and that question number one is from the group accounts. So without any delay, let's have a quick revision about the group accounts, quick revision, and then we will do the multiple questions of the group accounts from the past paper. So without any delay, let's start. So for revision purposes, I will be using the notes. So dear students, first of all, just remember uh, to cover the consolidation, to cover the group accounts, we have multiple accounting standards, which includes IFRS 3, which is an accounting standard of business combination. Then we have IFRS 10, which deals with the consolidated financial statement. Then we have IS 28, which deal with the accounting of associates and joint venture. But we have another accounting standard which is relevant to the group accounts to some extent, that is IAS 27. IAS 27. IAS 27 is a standard which give us the guidance that how we should account for the investment in associates, subsidiaries, and joint ventures in our individual financial statements. So, dear students, first of all, remember it is IFRS 10 which requires the parent company to consolidate all its subsidiaries as a single economic entity, all its subsidiary as a single economic entity. So, first of all, remember the reporting date of the parent and subsidiary should be same. If the parent and subsidiary reporting dates are not same, they are different. Like for example, parent company financial year end is 31st December and the subsidiary is 30th June, 30th September, or 30th November. In that case, first of all, the subsidiary company's financial statement should be redrafted as per the financial year end of the parent company, and then the consolidation should be take place. But there is some exemption as well. In some cases, the subsidiary company is not required to prepare the financial statement as per the parent company financial year end. And that exception is available if the time difference between the parent company year end and the subsidiary company year end is not more than 3 months. Not more than 3 months. For the overlapping period, adjustment will be done in the financial statement, and that time period should remain consistent from reporting from year to year, from reporting date to reporting date. In that case, the subsidiary company does not need to prepare the new set of financial statement as per the parent company year end. If the time difference is not more than 3 months, and for these 3 months in which we have overlapping thing, that for that period adjustment will be done, and that time period, that difference will remain consistent over the period. In that case, the subsidiary company is not required to redraft its individual financial statement. And one more thing, it is quite possible that for the same accounting transaction, the parent company is using a different accounting policy and subsidiary company might be using the different accounting policy. Like for example, for inventory valuation, the maybe parent is using the FIFO method for the same class of the inventory, and subsidiary is using the weighted average. But in group accounts, there will be only one accounting policy. There will be only one accounting policy, and that would be normally the accounting policy of the parent company will prevail. Similarly, it is quite possible for plant and machinery, the parent company is using revaluation model and subsidiary is using the cost model. But in a group account, there will be only one accounting policy will be adopted for the property, plant, and equipment, and obviously it will be the accounting policy of the parent company. So a uniform accounting policy should be used while preparing the consolidated financial statement. Exemption from presenting consolidated financial statement. Can a parent company be exempted from presenting the consolidated financial statement? Means the parent company is not required, or could be exempted, could be allowed, that there is no need to consolidate there is no need to present the consolidated financial statement. Answer is yes. Yes, that exemption is quite possible. That exemption is quite possible, provided that certain conditions have been fulfilled. Provided that certain conditions have been fulfilled. Uh, Number one condition is that the parent is itself is a subsidiary or partially owned subsidiary of another company. Like, let's say A company has 70% holding in a B company, but A itself is a subsidiary of Y company. So, first condition will be fulfilled for the A company not to present the consolidated financial statement with the B company. If the A if itself is a wholly owned subsidiary or partially owned and with the consent of their NCR. Its debt or equity instruments are not publicly traded. This company A is not a public company. Its instruments are not traded in a stock market. Or it did not file, or it is not in a process of filing the financial statement with regulatory organization for the purpose of publicly issuing the financial instrument. And the ultimate or any intermediate parent produce the financial statement available for public use that comply with the IFRS, include all the subsidiaries. And that company A, which is a wholly owned company, its ultimate parent company prepare the consolidated financial statement, and this Y include all its subsidiaries, including A and B, because B is also a subsidiary of the Y, indirect subsidiary of the Y, and Y consolidate A and B. If all these conditions are satisfied, all these four conditions are satisfied, then the A company, yes, have an exemption from not presenting the consolidated financial statement. Because when the Y will, and it is, this exemption is only available if the A is not a public limited company, or it's not in a process to become a public listed company. And its ultimate parent company prepare the consolidated financial statement, which include A and B both. If all these conditions are satisfied, then the A company will be allowed, or will be allowed to not to produce the consolidated financial statement. Number one. Next, we have IAS 27, as I told you. In this IAS 27, we discussed that how the investment in subsidiaries, associates, or joint venture will be accounted for in the separate financial statement of the invested company or the parent company. Now, the parent company, the invested company has a choice to present the investment in subsidiaries, associate, and joint ventures in their individual financial statement, either at cost, or either at fair value under IFRS 9, or for associate investments and joint venture, they can also use, or can use, the equity method as well. But this is allowed only for investment in associate or joint venture. So if I talk about a subsidiary company, they have a choice to present it at a cost or to present at according to IFRS 9. But if we talk about associate or joint venture, they have three choices: to present it at cost or at fair value as per IFRS 9, or they can use equity method as well to account for the investment in associate in their individual financial statement. And but keep in mind, if in case of associate company or joint venture company, if investor company does not have any subsidiary company, if parent company, investor company does not have any subsidiary company, then for the investor company, it is mandatory that the associate investment or investment in associate, investment in joint venture must be accounted for using the equity method in their individual financial statement as well. In that case, the first two options would not be available to account for the associate. If the investor does not have any subsidiary company, and if they does not have the subsidiary company, there will be no consolidated financial statement. So in that case, associate company will be accounted for using equity method in their individual financial statements, in their individual financial statements. Subsidiary. What is a subsidiary company? Dear students, subsidiary company is a company that is controlled by another company. A company which is, dear students, controlled by another company. Controlled. That means to be, if you want a company to be your subsidiary company, you must have a control. Now, what is a control? Control means you have a power to govern the financial and operating policies of that entity. Power to govern. And the power means your existing right that give the current ability to direct the relevant activities of the investee. Like for example, the key point in a definition of subsidy is control, and investor control an investee if and only if investor has the following. They have a power over the investee relevant activities like voting right, like right to appoint or dismiss or remove the key management personnel, right to appoint or remove another entity that direct the relevant activity, management contract. For example, sell and purchase of the goods and services, manage the financial asset. So basically, you should have the power over the investee, number one. Number two, there should have been an exposure to the variable return over that company over which you have a control. You have a right to variable return or exposure to variable return, like dividend payments, like profitabilities. These are your variable returns. The profit cannot be fixed, earning per share cannot be fixed, dividend cannot be fixed. So you have exposure or right to variable returns or exposure to variable returns. That means you should have an equity investment. And number three, you have the ability to use that power as well. You have the ability to use that power. You have the ability to direct the activities of the subsidiary on over which you have a control. And that means you have an ability to effect the returns of the company, of that company over which you have a control. So in order to have a control, you should have a power. You should have an exposure to variable return or right to variable return. Exposure to variable return or right to variable return simply means that you have investment in equity. You have an investment in equity of that company. By giving debt or by investing in a debt, you cannot have the control. You cannot have the control. You can only have a control if you have invested in an equity instrument, like you have investment in ordinary shares, like you have an investment in equity options, And number three, you have the ability to use that power as well. If you can establish these 3 points, that means you have a control over the company. Normally, we have studied that to get the control, you should have more than 50% voting right, and that is 100% correct. If you have more than 50% shareholding, the company will be considered as your subsidiary company. Company will be considered as your subsidiary company. But dear student, it is not always mandatory that you should have more than 50%. You can still have a control even you have less than 50% voting right. So control does not only rely on the number of shares. If you does not have more than 50%, you can still have a control. Now, how that control can be existed if you have less than 50% through Management Contract Act or by through law, you sometimes get the control of the company. Now, to understand all these concepts, we have an example of Edward Company. Kindly, kindly read this case study. Kindly read it. Okay. Have you read it? So, Edward has a 40% voting right in a Hope company, and the remaining 60% is distributed among the other investors, but no investor hold more than 5%. And there is a shareholder agreement which give Edward right to appoint and remove and set the remuneration of the management responsible for the key business decisions of the Hope company. Who has the right to appoint and remove the key management personnel? Edward company through the management contract. And to change this contract, if the other shareholder want to get back this power from the Edward company, they need two-third majority. Two-third means they must have 67% voting in order to get back this right from the Edward company. Now, according to the definition of the control, which I have discussed, that you have a power to direct the relevant activities and you have the exposure to variable returns or right to variable returns, and you have ability to use that power. Whether we can say that Edward company has a control over the Hope company, can we say? Now, first of all, the first thing is a power over the relevant activities. Does the Edward company has a power over the relevant activities of the Hope company? Now, at the first glance, at the first, when we read the first line, we have 40% voting right. Now, obviously, the 14% voting right normally are not considered sufficient to give the uh, controlling right or give the power which can be used to direct the relevant activities. Okay. So at the moment, if we read it, absolute size of the Edward in a Hope is 40%, and the relative size of the other shareholder alone are not conclusive in determining whether Edward has a right to sufficient to give it power. Okay, 40% is not sufficient. But however, there is an agreement. There is an agreement between the Edward and the other shareholder, which gives the Edward right to appoint and remove and set the remuneration of the key management personnel who will be taking the key decision. So the key management personnel will be appointed by the Edward company. Now, this fact that they have the right to appoint the key management personnel, and this right cannot be revoked unless two-third votes are given in a favor to revoke this right. This right cannot be revoked, and two-third is not possible because 40% is holding by the Edward company. If in for a one instance we assume that all the remaining shareholders come together, they are 60%. They cannot take this right back from the Edward company unless the Edward company is ready to surrender the right. So this thing or this element give the power to the Edward company over the Hope company. Okay, so that was the first condition, power. So they yes, the Edward has the power to direct the relevant activities. Okay, you got it? And number two, the exposure to the variable returns or right to variable returns. Now, dear student, the Edward has a 40% shareholding. Now, 40% shareholding is through ordinary share. And on ordinary share, one of the return is in a form of dividend, and you know dividend is not fixed. It is a variable return. It depends on the profitability of the company, and profitability of the company depends on the various expenses, including interest expense, including tax expense, operating expenses. Okay, so yes, the Edward also have the right or exposure to the variable return as well. So the second condition is also fulfilled, satisfied. Now the third one is the ability. The third condition is whether the Edward has the ability to use that power or not. Now, the fact that Edward might not exercise the right, might not exercise the right to appoint, remove, and set the remuneration of the home management should not be considered when determining whether Edward has a power over the home. It is just the ability to use the power which is required, and this ability comes from the shareholder agreement. Now, there is a shareholder agreement, if you remember, and that agreement gives the ability to the Edward company to exercise the control over the Hope company. So there is a power over the Hope company to direct the relevant activities. There is the exposure or right to variable return, and through the management contract, there is the ability to use that power as well with the Edward company. So considering all these facts, we will be concluding, yes, the Edward has a control over the Hope, and the Hope company will be considered here as the subsidiary company of the Edward company. Hope company will be considered as a subsidiary company of the Hope company will be considered as a subsidiary company of the Edward company. Edward has the control over the Hope company. You got it? Any question? Okay, now another exclusion of a subsidiary from consolidated financial statement. Like for example, if we have number of subsidiaries and we are a parent company, do we have a right which permit us not to consolidate certain subsidiaries? Do we have such right? Normally, the answer is no. IFRS 10 does not permit us that we exclude any company which meet the definition of the subsidiary company from consolidation. We have to consolidate all our subsidiaries company. Whatever we give the reason that the nature of business activity is different, the company is loss making, whatever the reason, we will consolidate our all the subsidiaries company. Even we have disposed it, we will treat it as a discontinued operation. But every subsidiary company which we have during the year must be consolidated. There is no exclusion. There is no exclusion except for the investment entities. Investment entities are, dear student, those entities which has the ordinary activities to make uh, investment in a form of buying the equity shares of the another company. And they does not buy the equity shares, buy the ordinary share to run the business. They just uh, purchase the share for the investment purposes. They carry their investment at fair value. They have more than one investor who gave them the fund through which they buy the shares and then they sell it, and the return is distributed among the investor who have given the money. Now, such companies are investment companies. Now, sometime investment company might get more than 50% shareholding in a company. So if they have more than 50%, normally it will be considered as a controlling right. And yes, it is a controlling right, but the investment entities does not make investment in other companies for the purpose of running the business. They are just, their objective is just to make investment and to make the short-term returns or speculative returns. So the investment entities have the exception. If they get a control in their investment activity, they does not need to consolidate that subsidiary company. So an exception to the non-exclusion, no exclusion from consolidation principle is made where the parent is an investment entity. Investment in subsidiaries are not consolidated and instead they are held at fair value through profit and loss. This allows an investment entity to account for all its investment, whatever interest is held at a fair value through profit and loss. IASB believes this approach provides more relevant information to the user of the investment entity's financial statement. The accounting treatment is mandatory for entities meeting the definition of investment entity. Obtain funds from one or more investors for the purpose of providing those investors with the investment management services. These are the characteristics. These are the characteristics of the investment entity. And they measure and evaluate performance of substantially all of its investment on fair value basis. They have more than one investment. They have more than one investor. They has investor that are not related parties to each other. It has ownership interest in a form of equity or similar interest. So they have the exception. Other than that, you have to consolidate all your subsidiaries company. Intra-group transaction with the subsidiary. Dear student, it is quite possible that the parent company and subsidiary company might have an intra-group sale. Now, intra-group sale in a consolidated profit loss account cannot be consolidated. So the reverse, we will reverse the sale from the profit loss account while consolidating parent and subsidiary intra-group sale. Similarly, unrealized profit on the intra-group sale inventory which still exists at the year end will be eliminated. Intra-group balances, payable and receivables are eliminated. They cannot be consolidated. Unrealized profit is eliminated from intra-group sale of goods and intra-group sale of the property, plant and equipment, and elimination of intra-group profit, intra-group balances, intra-group sale and purchase, intra-group income expenses, just because we consolidate the parent and subsidiaries as a single economic entity, Now, when we when we have a subsidiary, we consolidate it. In consolidation, we first of all, identify the acquirer. Acquirer is a company, dear student, who has the control. Now, what is the control? We have discussed. Then we determine the date of acquisition. The date of acquisition is the date when we get the control. Then we measure the asset and liabilities of the subsidiaries at a fair value, at the date of acquisition, and then we measure the goodwill or bargain purchase. Bargain purchase is basically the negative goodwill, and negative goodwill is known as bargain purchase, and it is considered as a parent company income if we have a bargain purchase. Now, the NCI at the date of acquisition is measured in two ways. One is the proportionate share of the fair value. which is known as partial goodwill, and the other method is full goodwill, at which we measure the NCI at fair value at the date of acquisition. At the date of acquisition. Now, like for example, just to partial and full goodwill method, how it will work. Dear students, let's say P Limited acquired S Limited 80% share on 1st January 20x1 for, let's say, 100,000 US dollars, and fair value of NCI at acquisition date was, let's say, was $18,000. And fair value of subsidiary limited net asset at acquisition date was $80,000. Now, I'm just taking this data to explain the full and partial goodwill. Now, if we talk about the full goodwill, which we normally use in FR as well as in SBR, normally the full goodwill method is used. And in full goodwill method, NCI is measured at fair value. So in full goodwill method, we will take the investment at the fair value of the consideration at the date of acquisition, which is 100,000 US dollar, and we plus the NCI at fair value, which is 18,000. So the total will be 1,18,000, and minus the fair value of net asset at the date of acquisition, which is 80,000, and 38,000 is the value of goodwill. This is the full goodwill method. Here I have measured the NCI at the date of acquisition at fair value. The other method we have in IFRS 3 that is known as partial goodwill method. In partial goodwill method, investment will be same, 1 lakh, but here the NCI will be taken at the proportionate value of the fair value of the net asset at the date of acquisition. The fair value of the net asset is 80,000 and proportionate value will be 20%. So NCI value will be 16 and total value will be 1 lakh 16,000 and less fair value of net asset at the date of acquisition, 80,000. And the partial goodwill will be 36,000. So partial goodwill is basically the goodwill where I am recording only 80% share of the goodwill, only the parent share of the goodwill. And in a full goodwill, I am recording the 100% goodwill, which include the NCI share of the goodwill as well. And the difference between full and partial is the way in which we measure the NCI at the date of acquisition. If we are taking the NCI at the fair value of the NCI, the goodwill method which we are using will be considered as the full goodwill method. And if we are using the NCI at the proportionate value of the fair value of the net asset at the date of acquisition, the same goodwill will be considered as a partial goodwill method. Now, it has a very important implication when it comes about the impairment test, especially on cash generating units. Hopefully, you have watched the recording lectures of the IS 36 and you understand the concept of the cash generating unit. Now, in cash generating unit, we allocate the goodwill. Now, if the goodwill allocated to the cash generating unit is a partial goodwill, in that case, in order to conduct the impairment test, you have to gross up the goodwill. Because if we do not gross up the goodwill, we do not get the right impairment to be recorded in the cash generating unit. If we having the full goodwill method, then there is no implication. But if we have a partial goodwill and we are conducting impairment test, then before conducting the impairment test, we will gross up the partial goodwill to the full goodwill in order to determine the impairment loss. So, this was the partial and full goodwill. I'm not going into detail that how to prepare consolidated profit and loss or consolidated balance sheet. That I will discuss in the practice question. I'm just giving you the main idea. Now the associate. Now associate company is a company in which you have a power to put significant influence. Now significant influence come if you have representation in a board of director, when you have participation in making a policy of the company, when there is a material transaction between you and your investing company, managerial personnel exchange, provision of essential techniques, or if you have more than 20% shareholding in that company, it is presumed that you have a significant power. Now, point to be remember, you will get the note. I will share the notes in a WhatsApp group, okay, or here. But these notes, if you are a student of the regular class, these notes should be available on LMS as well. Hashim, it should be available on LMS. But just a minute. I will share the notes. I will share the notes in the meeting chat. Don't worry. Okay, I have shared the notes in the chat box. So now, associate. Associate company in which you have a power of significant influence. To account for the associate, we have equity method. In profit loss account, in equity method, we just need to take the profit share of the associate. Profit share of the associate is considered in a profit and loss. Not a dividend. If we have considered dividend, that should be replaced from the profit share, And in that profit share, if there is any unrealized profit or intra-group sale, that need to be adjusted. In statement of financial position, we calculate the carrying value of the investment in associate, in which we take the carrying value, opening value of the associate or cost of the investment in associate. We take the share of post reserve and we deduct the impairment loss on the associate, and we arrive at the carrying value of the associate. Like the we have intragroup trade between parent and subsidiary, and we eliminate the unrealized profit. Similarly, the unrealized profit is also eliminated if there is intragroup sale with the associate company. But in this case, we only eliminate the share of the profit share. Associate, only the share of the unrealized profit is eliminated. Like for example, if you look at the example number one, associate P purchase 60% holding in S. Parent purchase 60% holding in S on 1st January X0 for 6.1 when the retained earning were 3.6 million, and the retained earning at 31st December X4 is 10.6. And since acquisition, there is no impairment loss on a goodwill. We also have 30% holding in A, which acquired on 1st July X1 for 4.1, and on that date retained earnings were 6.2, and at 31st December X4 there are 9.2 million. Impairment, associate is impaired by 500, investment in associate impaired by 500,000. During the year, associate A sold goods to P for 3 million at a profit margin of 20%, and 1/3 of these goods remain in a P inventory at the year end, and at 31st December X4, the parent company retained earnings are 41.6 million. First of all, what accounting adjustment in relation to unrealized profit required in a consolidated financial statement of the P for the year ended 31st December 20X4. Now, dear student, as far as the unrealized profit is concerned, it will be calculated. Intragroup sale is total 3 million, on which margin of 20% has been charged, and 1/3 goods are still in the inventory. So the unrealized profit will be is 200. Now you need to take the 30% share which we have invested in associate, 30%. So the 30% is 60. Now let me tell you, if the goods are sold by parent to associate, if the parent company has sold the goods to associate, then to eliminate the unrealized profit, this entry should be done, in which group retained earning or cost of sale or group retained earning should be debited, and investment in associate should be credited if the goods sold by parent to associate company. But in this case, these goods are sold by associate to parent. And if the goods are sold by associate to parent, the calculation will remain the same. Debit side will remain the same. Group retained earning or cost of sale will be debited by 60. But here, instead of crediting the investment, we will credit the inventory. Inventory will be credited by $60 because here goods are sold by associate company to parent company. Inventory will be credited. But if the goods are sold by parent to associate, in that case, the investment in associate would be credited. Okay. The second point was to calculate the investment in associate. So we have purchased the associate company for 4.1 million. Now you will take the post reserve share. When you purchase the associate, reserve was 6.2 and now they are 9.2. So there is an increase of 3,000. And 30% belongs to us. So we will take 900. And impairment is 500. So the carrying value of the associate will be 4,500. And as far as the group retained earning is concerned, parent company retained earning were 41,600. Unrealized profit is 60. Group share of the post reserve is 900. And impairment on associate is 500 will be debited in GRE. So the closing retained earning will be 41,600, not just a minute, not the closing. There is one more thing, which is the post reserve of the subsidiary company. They acquire a subsidiary company. On the date of acquisition, their retained earning were 3.6 and now they having 10.6. So there is increase of 7,000, in which 60% belongs to the group, 4,200. So if you combine these values, 41,600 parent retained earning minus 60 unrealized profit plus 900 share of associate, impairment loss of associate will be minus, and 60% share of the post reserve of the subsidiary, which is 4,200. So the closing retained earning are 46,140 US dollars. $46,140, and value of the associate is 4,500. Okay. Measurement period. Dear student, measurement period is a 12-month period from the date of acquisition. From the date of acquisition, next 12 months are known as measurement period. Now, if in those measurement period, we get any information which is relating to the date of acquisition, that will be considered as the information arise on the date of acquisition and goodwill will be recalculated. But after the 12 months, any information which we will get, even if that information is relating to date of acquisition, that would not be affected or will not affect the calculation of the goodwill. They will be adjusted in a profit and loss. So measurement period, if I summarize, is the time period of the 12 months from the date of acquisition. If in those 12 months period you get information, if that information is relating to the date of acquisition, that will be reflected in a goodwill. And if that information is not relating to the date of acquisition, then it would not be reflected in the calculation of the goodwill. But every information which we will get after 12 months, whether it is relating to date of acquisition or after the date of acquisition, that would not affect the calculation of the goodwill. This is known as measurement period. Dear student, as you know that on the date of acquisition, we have to record the assets and liabilities of the subsidiary company at fair value. All the asset and liabilities of the subsidiary company will be measured at fair value, including property, plant, and equipment, intangible assets, even a contingent liability. Any asset or liability should be measured at fair value at the date of acquisition. And the consideration in calculation of the goodwill should be measured at the fair value of the consideration at the date of acquisition. And we have different forms of consideration like cash, like contingent consideration, like deferred consideration, like share exchange. Whatever the form of consideration we have, that consideration should be measured at the fair value of the consideration at the date of acquisition. If in the individual financial statement we have recorded the investment in subsidiary at a fair value, like for example, at the date of acquisition, the fair value of the consideration was $100. But in parent individual financial statement, we are carrying it at fair value and now the fair value is 120. Now, while calculating the goodwill, we will remove the fair value gain of 20 and we will remeasure the investment at $100 for the purpose of the calculation of the goodwill. So every consideration, whether it is share exchange, whether it is cash, whether it is deferred consideration, whether it is contingent consideration, it should be measured at fair value of the consideration at the date of acquisition. Now, if we have contingent consideration in a form of cash or deferred consideration in a form of cash, the fair value would be the present value. And any changes in a fair value of the cash, contingent, and deferred consideration will be recorded in profit and loss of the parent company. But keep in mind, if we have a contingent consideration or deferred consideration in a form of equity instrument, they will be measured at the date of acquisition at fair value, but after the date of acquisition, they will not be remeasured. They will remain at the fair value of the instrument of equity, which was at the date of acquisition. But contingent consideration of a cash or deferred consideration of the cash will be remeasured after the date of acquisition, and any changes will be reported in profit and loss. Now, look at the illustration number 4. We are public company purchase 60% interest of another company. On 1st January X1, 160 million is a cash, 120 million is payable on 31st December, and an amount equivalent to 3 times of the profit after tax whole for the year ended December X1 payable on 31st March X2. It is a contingent consideration, and 5 million fee paid for the due diligence. On 1st January X1, fair value attributable to the consideration based on profit was 54, and at 31st December, it becomes 65. Any change arose as a result of the change in expected profit, and appropriate discount rate where necessary is 5%. Now, dear student, it is a consideration at the date of acquisition. It will be measured at fair value. So the cash consideration fair value was 160. 120 is the deferred consideration. It will be paid after the 2 years, and the deferred consideration will be recorded at present value, which is its fair value, and present value will be 120 into 1.05 raised to power minus 2. So 1.05 raised to power minus 2 into 120 it is 109, almost 109. Contingent consideration will be measured at fair value, and at the date of acquisition, its value was 54, and the due diligence fee of 5 million In the individual financial statement under IFRS 9, it will become part of the investment if it is carried at fair value through other comprehensive income. But in the consolidated books, the due diligence fee of 5 million will be treated as a parent company expense. It will be treated as a parent company expense. It will be expense out in a group financial statement. So at the date of acquisition, the total consideration is 160 plus 54 plus 109. So it is 323. Now at the year end in a group account, the deferred consideration and contingent consideration which are in a form of cash will be remeasured. Like contingent consideration has a fair value of 65 million, so there is a change of 1 million, 11 million. It will be recorded in a profit and loss account as a parent company expense. Because this contingent consideration is in a form of cash, so it will be remeasured and any change will be recorded in profit and loss. But if it is in a form of equity, but if, then it would not be remeasured again. Okay. And the deferred consideration is 109. It will also remeasured 109 into 5%. It will give you 5.45. It is also recorded as a parent company expense because we have discount the value at 109, so it will be unwinded at the year end, and the unwinding will be treated as a parent company expense. So and you can look at here 322.8. I have rounded at 323, and below is the explanation that how it will be measured at the date of acquisition and how the changes will be reported. Kindly read it. Any question? Any question? And asset and liabilities of the subsidiary company at the date of acquisition will be measured at fair value, will be measured at fair value. And there could be contingent liabilities. Now, contingent liabilities in individual financial statement are disclosed, remember, but if a subsidiary company has a contingent liability, then in a group account at the date of acquisition, it will be recognized if it is a present obligation and fair value can be measured reliably. Now, not contingent liability. Now, let me discuss. This is a very important point. Contingent liability is a possible obligation or it is a present obligation, but it is not recognized as a provision because outflow of economic benefit was not probable. So if we have a contingent liability which was not recognized we only because the outflow of the economic benefit was not probable, in that case, in a group account, that contingent liability will be recognized as a liability, in the group accounts at the date of acquisition. Any deferred tax asset and liabilities at the date of acquisition will be recognized. Any employee benefits adjustment at the date of acquisition will be recognized. Indemnification of asset will be recognized. Reacquired right means before the date of acquisition, parent company give a license to subsidiary. So when the parent acquired the subsidiary, that large license is again reacquired by the parent company. That is known as reacquired right. So it will be measured at the fair value, which is based on the remaining term of the license. Share-based payment adjustment would be considered. Asset held for sale. In short, asset and liabilities of the parent company will be measured or must be measured at fair value at the date of acquisition. It is a simple law, simple principle of IFRS 3 in order to calculate the goodwill. Now, that was the quick revision of the basic consolidation. Now, we will be doing some question. Okay. Now here I have the first question and I'm starting it from the ACCA Study Hub. But let me tell you, this loop fluid company question is might be from 2020. It is from 2020 past paper, 20 or 19. In which this question we have the background, then we have exhibits, then we have pre-populated spreadsheet in which we have to do the adjustments, and we have the required. So first of all, read the background. Let's read the background. Loop Fluid Co. is a parent of the group undergoing rapid expansion through acquisition. Loop Fluid Co. has acquired 3 subsidiaries in a recent year: Collison, Kristen, and Hammett Company. It also has an interest in a joint venture, which is the R Company. The financial year end is 30th June 2008, and the financial accountant has prepared the draft consolidated profit and loss, including the full unadjusted results of the Luploid, Christian and Hammond Company. Unadjusted results. The following exhibits provide information relevant to the question. Factory side, Christian, Hammond, Luploid and draft statement of profit and loss. Now, first of all, exhibit number 1. So, Luploid Co. acquired a factory. Luploid Company acquired 90% of the share of the Collison Company at 30th June exit. Collison Company had purchased factory sites several years prior to the date of acquisition. So L acquired C on 30th June exit, and C company had a factory site which they have acquired several years ago before the acquisition. Land and the property prices in the area had increased significantly in the year immediately prior to 30th June exit. Nearby sites had been acquired and converted into residential use. It is felt that should the Collison Company site also be converted into residential use, the factory site would have a market value of 24 million at 30th June 20 exit. 1 million costs are estimated to be required to demolish the factory and obtain the planning permission for the conversion. Collison Company was not intending to convert this site at the acquisition date and had not sought any planning permission at that date. Depreciated replacement cost of the factory at 30th June exit has been correctly calculated at 17.4 million. Now the requirement relating to this exhibit, the first requirement is using exhibit 1, discuss how the fair value of the factory site should be determined at 30th June X8 and why the depreciated replacement cost of 17.4 million is unlikely to be a reasonable estimate of the fair value. So how the fair value should have been determined? Now, dear student, when we talk about the fair value for the non-monetary asset like property, plant and equipment, the relevant standard is IFRS 13. IFRS 13 is the accounting standard on fair value measurement. Now, according to IFRS 13, fair value is the price which is agreed between the market participant at the measurement date, number 1. Number 2, the fair value is not entity specific value, not entity specific value. Fair value is a value which is based on the expectation of the market participant, because by definition fair value is the value which is agreed between the market participants at the measurement date. So what the entity is thinking about, that what will be the use of the asset, it is not important. The thing is important that how the market participant is expecting that how they can get the maximum from the asset. That should be the base to determine the fair value. Now here, if I apply this point here, now and the coalition company is not intending to convert the land into residential area or factory site into residential area, it is not important. Because if I make the fair value on the basis of the entity intention, then it will become entity specific value, which will be contrary to the IFRS 13. Number two, IFRS 13 also give us the guidance, especially for the non-monetary asset like property, plant and equipment, intangible assets, and investment properties. That fair value should be measured as per the uh, you can say strategy which can maximize the benefit, which is physically and legally and financially possible. Now, if I consider that point, the maximum benefit can only be get if we convert it, the factory site, into the residential area. Then it will be having the value of 24 million. And considering the demolition cost and conversion cost, so the fair value of the factory site should be 23 million, at the date of acquisition. Okay. Now the second point, why the depreciated replacement cost is not relevant here or is not appropriate. Now, dear student, depreciated replacement cost is a good method, is a good technique to measure the fair value. But however, it is only good if the other techniques or other ways are not available to determine the fair value. Like if we are talking about a very specialized nature asset, which very unique, in that case, we can use the depreciated replacement cost method. But in the case of the land and building, in case of the property, factory site, which has the market, and from where we can determine the fair value, for such assets, the depreciated replacement cost is not appropriate. So that's why we would not give preference to the depreciated replacement cost to determine the fair value here. So the fair value will be, 223 million, 24 minus 1 million. Okay. So that would be the answer of the exhibit number 1. And here you have the answer. Here you have the answer. And I would recommend you that kindly read it. By reading, you will get the idea that how you will express the knowledge in your exam. So at the start, you can see that they are defining the fair value as per IFRS 13 in first 2 paragraphs. Then how the fair value should be measured. It has been discussed in the 4th and 5th paragraph. Fair value is defined as a price which would be received to sell an asset or pay to transfer liability in an orderly transaction between the market participant at the measurement date. Fair value is therefore not supposed to entity specific, but rather than market focused value. The estimate consequently should consider what market would be prepared to pay for the asset. The market would consider all the alternative uses for the assessment of the price which would be willing to pay. Fair value should therefore be measured by considering of the highest and best use of the asset. There is a presumption that the current use would be the highest and best use. The highest and best use of the asset would appear to be a residential property, not the current industrial use. The intention of the C are not relevant as the fair value is not entity specific value. The alternative use would need to be based on fair and reasonable assumption. In particular, it would necessitate to ensure the planning permission to demolish the factory and convert it into residential property would be likely. Since the several nearby sites have been given such permission, this would appear be the case. The fair value of the factory site should be valued if converted into residential. Since cannot be determined on a standalone basis, a combined value of the landed building is calculated. The 1 million demolition and planning cost should be deducted from the market value of the 24. The fair value of the landed building should be 23 million. Okay. And why the depreciated replacement cost is not relevant here, is not appropriate here. As I told you, it is only appropriate if the other methods are not available to determine the fair value. But in this case, factory side, we have the other method, market-based method, in which we can estimate the fair value. Now here, if I use the depreciated replacement cost, it would undervalue the asset. So that's why it would be unlikely that we will be using, or it would not be appropriate that we use the replacement cost method to determine the fair value of the factory site. Now, requirement B of 8 marks, it is using exhibit 2, discuss the calculation and allocation of the Kristen impairment loss at 30th June next year. Your answer should include a calculation and an explanation of how the impairment would affect the consolidated profit and loss of the Luke Fluid company. Okay. So Kristen company. Here we have the exhibit relating to Kristen company. Question relating to exhibit number 2, requirement number 2, exhibit 2, Kristen company. I would recommend you that first of all, you people read it, then we will discuss the solution and we will solve it. Kindly read the exhibit number 2, Kristen company. So Lookfluid company acquired 80% of the equity share of the C company on 1st July export for 90 million. On that date, net assets were 88 million and NCI was measured using the proportionate method. Kristen and Company incurred losses during 30th June exit of 12 million and impairment review was performed. The recoverable amount of the Kristen Company asset was estimated to be 100. Included in this assessment was only the building owned by the Kristen Company which had been damaged in a storm and impaired to the extent of $4 million. That is a specific loss. And the carrying amount of the net asset of the C company at 30th June exit, excluding goodwill and impairment loss, is as follows. Building, plant, intangible asset other than goodwill and current asset already at their recoverable amount. None of the assets of the C company, including goodwill, have been impaired previously. C does not have a policy of revaluing its assets. L, the Luploid company has not made any entries in respect of C company in its draft consolidated profit and loss other than to include the income and expenses in its separate financial statement. So they have only included the income and expenses in the separate financial statement. Other than that, no adjustment has been made. So the question is how we are going to conduct impairment test on this company, which is a CGU, how we will allocate the impairment loss and how it would affect the consolidated financial statements. Now look at here. Let's first do the calculation and then we will discuss the calculation. Assets carrying value, loss, and here we have recoverable amount. Goodwill, then notional goodwill, property, plant and equipment, building, then plant and equipment, then intangible, and current assets. Now, first of all, if we look at the goodwill calculation, they are using the partial goodwill method. So first of all, investment, they have 90 million. NCI, at the date of acquisition, the fair value of the net assets was 88, in which 20% is the NCI share. So it would be the proportionate share of the NCI. $107, and we will less the net asset of the subsidiary at the date of acquisition, which is 88. So the goodwill will be at the date of acquisition 19.6 million. So the carrying value of the goodwill is 19.6 billion. But this is the partial goodwill. And I told you, in case of partial goodwill, we will gross up the goodwill. So this goodwill is 80%. So it will be gross up by 20%. So 4.9 is the notional goodwill. Without considering the notional goodwill, the impairment loss test would not be appropriate in cash generating unit. Yes, if we were using the full goodwill method, then there is no need to determine the notional goodwill. Building carrying amount is 60, plant is 15, intangible assets are 9, and the other current assets are 22. So the total value of the CGU is 130. And the recoverable amount is 100 million. So there is a loss of 30.5 which need to be allocated. Now, first of all, goodwill will be eliminated. No loss will be allocated to current assets, and 4 million loss is specifically will be allocated to building. So after allocating the loss of, we have allocated 19.6, 4.9 to the notional goodwill, and 4 impairment loss has been allocated to building. So out of 30.5, 28.5 has been allocated. 2 million loss is still need to be allocated. That will be allocated on the basis of carrying values of the remaining asset. So the total carrying value of the remaining asset is 24, 15 plus 9, multiply by 15. So 1.25 will be allocated to the plant and 0.75 will be allocated to the intangible asset. So the recoverable amounts will be as follows. So this is how we will allocate it. Now, why we have gross up the goodwill? It is very important to discuss. Dear student, the recoverable amount which is given in a question is considering the 100% value of carrying value of the company, which is a CGU. But in that CGU, the goodwill is the only asset which is the partial, which is only representing 80% of the asset. So without considering the 100% goodwill, the loss calculation would not be appropriate. That's why we have grossed up the goodwill. Now, how we will record this impairment loss? Dear student, we will credit the goodwill, but goodwill will only credit by 19.6. Because in financial statement, we have recorded only 19.6 billion goodwill. 4.9 is the notional goodwill. It is just for the purpose of allocation. It is not part of the double entry. Other than that, building will be credited by 4 million. Land will be credited with 1.75, and intangible asset will be credited by 0.75, and this will be with 1.25. And we will debit two accounts. One is the group retained earning and the other one is NCI. Now, group retained earning, the impairment loss of the goodwill will entirely allocated to the group retained earning. No loss will be allocated to NCI. relating to goodwill. Yes, the remaining loss, which is 6,000,075, 1.25 and 4. In this 6, 80% belongs to the group and 20% belongs to the NCI, belongs to the NCI. So this is how we will calculate and allocate the impairment loss if we are using the proportionate goodwill method. Got it? So here is the calculation. You can see the same calculation which we have performed. Okay. But the important thing is, and above is the calculation of the goodwill. But the important thing is that you people should read that how they have explained it, how they have explained the calculation. That is important because in SBR you have to discuss the answer as well. So kindly read it. Take 5 minutes and read the analysis. So they have just explained the calculation, that how they've calculated and especially how the impairment loss will be allocated. The goodwill impairment loss will only allocated to the GRE because it is a partial goodwill, and the remaining 6 million loss relating to plant, building, and the intangible asset will be allocated between group and NCI with 80 and 20%. Got it? Now the exhibit number 3. Using exhibit 3, explain how the consideration for the acquisition of H company, Hammond company, should be measured on 1st July X7. Your answer should include the calculation of the consideration and discuss why only some of the cost of the replacement share-based payment scheme should be included. So this is the exhibit number 3. Luplut company acquired 60% of the 10 million equity share of H company on 1st July X7 and paying 700,000 in a legal and other acquisition cost. It would be treated as an expense uh, on the acquisition of the subsidiary. The transaction cost is treated as an expense of the parent company in a consolidated financial statement. The 2L company share are to be issued for every 5 share acquired in a H company. These shares will be issued on 1st July X8 after 1 year, and the fair value of the share on 1st July X7 was $30. Now, this consideration, if I first of all discuss these lines, parent company incurred a transaction cost, it will be treated as an expense of the parent company in a consolidated profit and loss, and they have a share exchange, a deferred share exchange. Now it's a deferred consideration in a form of equity, and it will be measured at the fair value at the date of acquisition, and any subsequent changes will not be incorporated. Now, what is the value of this consideration? 10 into 60%. So 6 million share has been acquired, and for every 5 share acquired, the Luplut company will issue its 2 shares, and market value of the each share of the parent company is 30. So the consideration, deferred equity consideration, will be equals to 72 million. So 72 million is the fair value of the consideration at the date of acquisition, which is in a form of share exchange, deferred share exchange. Okay. And as per IFRS 3, all the consideration which we have given to acquire the subsidiary company should be measured at the fair value of the considerations at the date of acquisition. Okay. And now, H company has previously granted share-based payment to its employee with a 3-year vesting period. At 1st July X7, employee had completed their service period but had not yet exercised the option. The fair value option granted on 1st July X7 was 50 million. As the part of the acquisition, the Luplut company is obliged to replace the share-based payment scheme of the H company with the scheme of its own, which has the following details. Luplut company will issue 100 options to each of the H company 10,000 employees on 1st July X7, and it is conditional they will work further for 2 years. And at the date of 1st July exam, it was anticipated that 10% staff would leave over the vesting period. And this was also the expectation at the year end as well, at 30th June exit. And the fair value of the each option at the grant date was $20. Now, dear student, share-based payment is the issue of IFRS 2. But, however, we have studied in the scope of IFRS 2 share-based payment. If at the date of acquisition, the parent company is obliged to replace the subsidiary company share-based scheme, then the part of the scheme replaced will be considered as the purchase consideration. Now here, the parent company is obliged to replace the subsidiary scheme. Now, at the date of acquisition, the fair value of that scheme is 15 million. Now, this 15 million will become part of the purchase consideration if the parent company is obliged to replace, which is true, the parent company is obliged. But this 15 million will become part of the purchase consideration if no further service period is required by the parent in a post-acquisition period. But here, a 2-year further period is required. So now, how much part will become part of the purchase consideration? We will divide it by 5, 3 years previously and 2 years further. And till the date of acquisition, 3 years has been completed. So at the date of acquisition, the 9 million out of 15 million will become part of the purchase consideration. So 72 plus 9. So the purchase consideration will be 81 million US dollar. Now, the total replace scheme value is, let me tell you, 10,000 employees into 100. And at the date of acquisition, fair value of the scheme is 20. And 10% employees are expected to leave during that period. It will give you total 18 million. The total replace scheme has a fair value of 18 million, out of which 9 million is related to purchase consideration, which will become part of the purchase consideration. But remaining 9 million is relating to post-acquisition period, which will be recognized over the remaining vesting period, which is 2 years. So 9 divided by 2, 4.5 million need to be recorded as a part of the share-based payment scheme in a consolidated profit and loss account. The 9 million will become part of the purchase consideration at the date of acquisition. At the date of acquisition, part of the purchase consideration. So now look at the answer as well. Kindly read it. IFRS 3 business combination require all consideration to be measured at fair value on acquisition of a subsidiary. This will include the deferred shares, but not the legal and acquisition cost, which must be recognized in an operating category of the profit and loss. Since the locality is obliged to replace the share-based scheme of the H company, the replacement scheme should also be included in a consideration. The amount to be included in a consideration proportion of 50 million acquisition date fair value of the existing scheme that relate to the vesting period before the acquisition when compared with the greater of the total vesting period or the original vesting period. So total vesting period become 5 till the date of acquisition, 3 years has been completed. So out of 59 million relating to the purchase consideration. So the purchase consideration will become total 81 million US dollar. 72 is the purchase consideration in a form of share exchange, deferred share exchange, and 9 billion in a form of replace scheme for which the parent company is obliged to replace. Got it? And then the final requirement we have using the pre-populated spreadsheet response option. With exhibit 2, 3, and 4 and your previous answer, adjust the draft consolidated statement of profit and loss for the year ended 30th June 2008 in order to prepare the corrected statement. So now we have to correct this statement with exhibit 1, 2, 3 and exhibit 4 relating to our company. Okay. And read the last line as well of exhibit 2. The Lupluid company has not made accounting entry in respect of the acquisition of H company. Since acquisition, H company has made a profit of 21 million. This is the profit of the Hammond company. Okay. And this profit has been consolidated here. But the uh, transaction which we have discussed relating the purchase consideration and the share-based payment, that is not considered in the pre-populated spreadsheet. That need to be adjusted here. Okay, but we will do this requirement. We will redraft the profit loss account. But before that, we will take a short break for 20 minutes. And after the break, I will redraft the profit and loss account with the exhibit which we have discussed above. So kindly take a short break for 20 minutes. Okay, welcome back. Now we have the last requirement of this question using the pre-populated spreadsheet response option with exhibit 2, 3, and 4 and your previous answer. Adjust the draft consolidated profit and loss for the year ended 30th June 2008. So first of all, they have told us that they have only considered the unadjusted values in a consolidated profit and loss account. And the fault Kristen Hammond company adjustment need to be adjusted. And there is exhibit number 4 as well, which is our company. On 1st January, we had said L company acquired 40% interest in a supplier. 40%. Our company at a cost of 28 million, obtaining a joint control. In a year ended 30th June exit. Our company reported profit in a separate financial statement is 15 million. Since the Luclid company shares in our company, it has consistently bought goods for 1.5 million from the supplier every month. Our company has set a selling price to Luclid company achieve 20% margin. And 30th June exit, Luclid company has goods supplied by our company in its storeroom. Uh, and these are measured at the cost of 2 million. At the cost of 2 million. So they still have inventory in intra-group sale from R 2 million. So R is a, you can say is an associate or a joint venture on which equity method will be applied. So that need to be considered as well in the uh, pre-populated spreadsheet. And this is a pre-populated spreadsheet in which we have to adjust the certain adjustment which we have discussed above. So one by one, the first adjustment which we need to consider here is about impairment of Kristen Co. Company. Now, if you remember, the total impairment we have, total impairment in Kristen Company, which we have to record is 25.6 million. So that 25.6 million isn't recorded by the Luclid company. Now we have to record it, and that will be recorded separately. And we will basically, I have just, let me tell you one thing, I have just take a picture from here. So I cannot write here, but here below the operating expense, impairment loss will be reported, and that is 25.6 million. 25.6 million total impairment loss. Number one. Number two, another thing which we have to report here is regarding the Hammond company. In Hammond Company, if you remember, we have 4.9, we have total post in post action. The replace scheme has a value of 18 million, out of which 9 million was relating to the purchase consideration and 9 million was relating to the post acquisition, which will be allocated over the 2-year period, vesting period. So 9 by 2, 4.5. So now Hammond Co. in operating expense in Hammond Co. One is share-based payment, in which 4.5 million need to be recorded, and another same Hammond Co. transaction cost. They have incurred the expenses to acquire the Hammond Co. and they were 700,000, means 0.7 million, and that 0.7 million need to be reported in profit and loss account. This is the parent company expense. So that will be reported here, need to be reported. And after this, we have the R company. In our company, profit for the year they have is 50 million, and we have acquired it on 1st January 2008, and the year end is 30th June. Okay, 1st January X8. So it's been 6 months. Now that need to be adjusted. But before I adjust the R company, we need to some working here relating to our company especially. Basically, there is unrealized profit, and that unrealized profit is in goods. They still have 2 million, on which our company charge 20% margin, and we have a 40% share. So 0.16 million is the unrealized profit that need to be adjusted. Yes, 2 million, 20% margin, and we have 40% share. So 0.16 million. Yes, 0.16 million. Yes. Now that need to be adjusted as well. Now coming back to the consolidated profit and loss account, we have a dividend from R, which they have recorded at 2.5 million dividend. First of all, our company share. But dear student, if we apply the equity method, they have a profit for the year 50 million, and it's been 6 months, and we have 40% share. So we need to record 3 million. We need to record 3 million. So what they have recorded, they have recorded a dividend share of 2.5. So I have to record 0.5 million. When I record the 0.5 million, this dividend share will become the profit share. Okay. And unrealized profit on R is 0.16. That need to be adjusted. So these are the adjustment which we need to perform, and after performing all these adjustments, the adjusted value which we will achieve here, adjusted profit and loss, revenue is still 325, cost of sale still minus 146, and gross profit is still 179. But operating expenses will be changed. Operating expenses were, I have to use the calculator. Operating expenses were 127, 4.5 and plus 0.7. So 132.2. They will become 132.2. Impairment loss will be 25.6, and the net share from the joint venture will be 2.84, 2.5 plus 0.5 minus 0.16, and they have the operating profit now, which will be now 24.04. Then there is interest expense, that is still 0.3 minus 3, and now the profit before tax will be 21.04, and tax expense is 11. So profit after tax will be 10.04. 10.04. Now from this 10.04, you have to take the NCI share. Now we have two NCIs. One is relating to the Kristen Co. Now, if you remember, the Kristen Co. loss for the year which they have reported is 12 million. In June X8, they have reported 12 million loss, and they have 6 million loss. Total loss is 25.6, but out of 25.6, 19.6 loss will be allocated only to group retained earning. So only from remaining 6 million loss, we will give the share of NCI. And NCI here is 20%. So Kristen Company NCI share is the share of loss, which is 3.6. And the second company is Hammond Co. Hammond Co. company has a profit of 12.6, but from that you have to deduct 4.5 is the share-based payment scheme expense, and in that 40% is the NCI share. So this is the analysis of the NCI share, and then you have the group share, and the group share will be equals to 10.64. 10.64 is the group share. Okay. So this is the adjustment which we will perform in a pre-populated spreadsheet. I have just copied the picture and placed the Excel, and I did the relevant adjustments. Now I will show you the answer at your screen. You can see it. So you can see their operating expense is 132.2. Dividend income become 0. Dividend income become 0. Okay. And yes, one thing I have one mistake I have done. Just a minute. How is it possible? Look at here. Basically, now we have IFRS 18. We have IFRS 18. Let me just give me a basically the dividend share will be eliminated. It will be zero here. It will be zero here. Why it will be zero here? Because dividend income is an investment category and it will be reported below the operating profits. Below the operating profit. So below the operating profit, impairment loss has been reported here in an operating expense separately from the operating expense. Other operating expense as other operating expense is 225.6. It has been reported. Now the R company. Now R company profit share of 3 million and unrealized profit of 1.6. So it will be reported below the operating activity under the investment category. So the presentation now matters. The investment activity should be reported below the operating activity. So our company share will be reported below the operating profit. By reporting the dividend from R above the operating profit, they have violated the IFRS 18, which now very specifically categorized that investment income should be reported below the operating profit as an investment category. Other than the answer will remain the same, but the presentation will be changed. Now coming back here to the given solution. So they have eliminated the dividend income. They incorporate the impairment loss of goodwill and other asset 25.6. Operating profit 21.2, then 2.84 the share of our company. Then they have profit before financing and income tax. Then they have interest expense. They have profit before tax. Then they have tax expense and profit for the year. Now it is very important that we take care of the presentation. When we adjust the investment category in the operating profit, we will arrive at profit before interest and tax. And then we will deduct the interest. We will arrive at profit before tax minus tax. We will arrive at the profit for the year. And from the profit for the year, we will allocate the share between group and NCI. Now they have allocate the 3 million to the NCI. This is the group share of the NCI share of the Hammond company, but they didn't consider the NCI share of the Christian company, which should have been considered. Just a minute. Yes, it should have been considered. Just a minute. What we have done. 3.6 million and 2.4, 3.6, yes. Okay, 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 okay. I have, I think, just look at here. The profit of the Hammond is not 12, it is 21. Yes, it's 21. Now it is rectified. Yes, okay. The Hammond profit is 10. So the NCI share total is 3 million. And we also have a 3 million. 3.6 of the Christian loss and 6.6 is the Hammond company profit share. So if you net the both, it is 3 million. So they have a 3 million NCI share and the group share is uh, 7.04. 7.04. 7.04 plus 3.6 and minus 6.6. Yes, 7.04 will be the group share. So this is how you will fill the pre-populated spreadsheet. And it is a pre-populated spreadsheet of the consolidated profit and loss account. Now, as we are talking about profit and loss account, now the thing which we need to take care after IFRS 18, that in IFRS 18, after introduction of the IFRS 18, profit and loss account has been categorized into five categories. One is operating activity, which started from the revenue, and it will continue till here. Now, in operating activity we cannot present any investment income. So by presenting the dividend income, before the operating profit, they did the mistake, which we have rectified by eliminating it. Okay. Operating expense, goodwill impairment loss is an operating expense, but it would be aggregated from the other operating expenses because goodwill impairment loss is itself is some have different nature. So it should be reported separately under the operating expenses. So I didn't merge the operating expense in other operating expense. I have or we have presented it separately uh, in the profit and loss account from the other operating expenses. After adjusting that, we have this operating profit, and from in this operating profit, I have shared the investment. I record the investment income, which is the share of the R company profit, which is 3 and 0.16 is the unrealized profit, so 2.84. And we arrive at profit before interest and tax, profit before financing and tax. Then we consider the interest expense, we arrive at profit before tax. Then tax category, we consider tax, we arrive at profit after tax. And there is another category, if it is applicable in a question, it is the profit share of the discontinued operation, which we do not here. And after that, we have distribute the profit between group and NCI. Okay. Any question? Just a minute. Just give me a 30 seconds. Just I'm looking for a question. Okay. Now we have another question. It is Shakal company. So the background of the question. This is a question in an exam real scenario. C company is a parent of the C group. It prepares the financial statement in accordance with IFRS accounting standard. Financial year end is 31st March each year. The following exhibits available on the left-hand side of the screen provide information to the relevant question. Initial purchase, it provides information about the initial purchase of the 30% of the equity share of the G company. Subsequent purchase provide information about the subsequent purchase of the 18% of the equity share in a G and the purchase of the share option. And the fair value of the net assets provide information about the fair value of the net asset of G company at 31st March X6. And then we have the draft consolidated statement of financial position. Now the requirements, using exhibit 1 only, justify why G company should be classified as an associate, not a subsidiary on 31st March 20x4. 31st March 20x4. Why it should be treated as a associate company, not as a subsidiary. So kindly read the exhibit. On 31st March X4, C company acquired 30% of the equity share of the G. The consideration consisted of $100 million cash. The carrying amount of the net asset of the green G company on 31st March X4 in its individual financial statement was 286 million, which was same as the fair value. Since the G has been stated at cost in a consolidated financial statement of the C group, so it is still carrying at cost. The remaining 70% of the equity share of G at 31st March X4 owned by few other investors, none of which owned more than 10% of the equity of the G. Analysis shows that all shareholders have voted independently in the past. There has been no clear past voting pattern suggesting that C is unable to directly influence the economic decision of the other investors. C and G share and the G share some key management personnel. The carrying amount of the G net asset at 31st March X6 is 348 million. The increase in net asset of the G since acquisition was solely due to profit, and G has paid no dividend since 31st March X4. So the question is why the green company should be treated as an associate, not as a subsidiary company. Now, dear student, in order to treat the company as a subsidiary, we have to establish that the C company has a control over the green company. And control means you have a power to direct the relevant activities or take the relevant decisions, like financial and operating decision, like appointment, removal of the key management personnel, the remunerations, such decision can the C company can take. This need to be considered exposure to or right to the variable returns and ability to use that power. Now, as far as the power is concerned, that whether the C company has a power, it is very to get the power, you should have 50% voting right, or there should be the management contract or the contract with the other shareholder, which will give the votes as per the direction of the C company. Now, this thing is missing here. There is no such agreement with the other shareholders who agree that they will vote as per the direction of the C company. There is nothing like that mentioned in here, and we assume that it is not the case. So, in the absence of that thing, you have only 30%, and with 30%, you does not have a power to direct the relevant activities. Yes, you have exposure to the variable return, but you does not have a power or you does not have a ability to use that power. So that's why it should not treat it as the subsidiary company. Yes, you have 30% shareholding, it is more than 20%, and you also share some key management personnel, the C and the G, the Checkle company and the Green company share the key management personnel as well. So considering it, yeah, the C company has a power to put significant influence, to put significant influence. So they have a significant influence, but they does not have the control. That's why the green company should be treated as an associate company, not as an subsidiary company. Okay, you got it? And let me, if I have the answer, written answer here, I will show you the answer as well. Okay, okay, yes, we have. Now, look at here. Here you have the answer. That why the C company should be treated as an associate company, not as an subsidiary company. So just read the answer. Significant influence is the ability to participate in a financial and operating policy decision of the investee, but is not control or joint control. IFRS 10 consolidated financial statements state that investor control an investee if and only if the investor has all of the following: power over the investee, exposure or right to the variable return, and ability to use that power. Control is presumed to exist if you have majority voting rights, usually if you have more than 50%. Okay. And since the C company owns 30% equity and there is no uh, contractual contract with the other shareholder, which would be ready to vote as per the direction. So considering only 30%, you cannot say that the Checkle company has a control over the green company. So that's why the green company should be treated as an associate company. Okay. And this will be explained here using the word processor response option. You have the response option, two response option, word processor and spreadsheet, and this exhibit answer relating to exhibit 1 will be right here in a word, and this answer will be right here, these points. Okay. Now, after this, moving towards the second part, using exhibit only, explain with calculation how the G should be accounted for in a consolidated financial position of the G group as at 30th June 20x8. Now, dear student, if we, with calculation, we need to explain it that only explain with calculation that how it should be accounted for. So dear student, it should be accounted for using the equity method. It should be accounted for using the equity method. Now they have keeping it at cost in the pre-populated spreadsheet. Coming out in requirement option. Okay, this is the pre-populated draft consolidated financial position. And in this draft consolidated financial position, it should be treated as per equity method. Now, here we should have the pre-populated. Okay, let me show you in the Excel. We have the Excel I will perform here. Now, how it should be accounted for? It should be accounted for using the equity equity method, dear students. It should be accounted for using equity method. Now, in equity method, we need to take the cost of investment, which is 100 million, and in that we will consider the post reserve share, and the post reserve share will be when you purchase that associate on that date, net assets was 286 and now they are 348. So 348 minus 286. There is increase of 62 in which 30% share belongs to the group. So the carrying value of the associate should be reported at 118.6. With this 18.6, the investment has been debited and this will be reported in a group retained earning as well. So this is how it should be accounted for. This is the answer of the requirement number 2, that how it should be accounted for at 31st March X8, how the investment in green company should be accounted for. So it should be accounted for using the equity method. Got it? Any question? Any questions, students? Okay. Now we will move towards the next requirement of this question. And that is using the exhibit using the exhibit number 2, briefly explain why the classification of the C investment in a G should be changed to subsidiary after the purchase of 18% additional shares. Now for that purpose, we have exhibit number 2. But before I go to the exhibit 2, look at the draft consolidated financial position. Due to some technical error in a spread response option, the spreadsheet is not available pre-populated. So I am telling you from the exhibit that this is the C company, green company investment 100. it will be eliminated and it will be treated as investment in associate, in which we will record it at 118.6. Okay, and the 18.6 will then adjusted in the group retained earning as well. Now towards the subsequent purchase. On 31st March X6, the C company acquired further 18% of the G company equity shares. 31st March X6. The remaining 52% equity share of the G at 31st March is owned by few other investors, none of which own more than 10% of the equity of the G company. On 31st March X6, the C also acquired some shares option in a G, exercisable anytime until 1st April X7. Exercise price of the option at 31st March X6 has just above the market price of a G equity share. G has been profitable for a number of years and the share price has been on an upward trend which is expected to continue. C would increase its ownership to 60% should the exercise its right. It is believed that there would be additional cost savings should be additional equity share to be acquired, as a decision at board level could be made more efficiently. So the requirement was that explain using the exhibit 2 why the classification of C investment in G should change to subsidiary after the purchase of the additional 80% after the additional 80% share. The answer of that part of the question is that it should be changed to subsidiary because now the C company first of all has become one of the majority shareholder, not more than 50% but 48%, and other shareholders not having the shareholding more than 10% on individual basis. So majority shareholder and one another reason, they have a share options. They have a share option as well. They have share option as well. And according to IFRS 3, if the investor has a share option in a company, and if it is likely that those share options will be exercised, if those options will be exercised, then those options should be considered in determining the control. So the option which they have, if they exercise it, their shareholding will become 60%, and it is likely that those options will be exercised. So considering those options as per IFRS 3, we can say that the C company now has a control over the green company on the date of 1st April X6 when they acquired further shareholding. Now you have the answer here as well. Kindly read it. The acquisition of the extra 18% equity share on 1st April X6 would now unquestionably make the C company significant minority investor. No other investor owned more than 10% of the equity, so the C company owned much higher proportional share, which is 48%, where other shareholder owned by the large number unconnected dispersed holder, it would be clear that power has been obtained. However, the other share are owned by just few other investors, which is unlikely to be considered a large dispersed group of unconnected shareholders. Potential voting rights should be considered in assessment of control. For these to be included in assessment, the right should be substantive. This would usually mean that they are currently exercisable and have an exercise price which is below the market price of the share so that they are in the money. In the sense, it is worthwhile for the investor to acquire extra share. In case of C company, they own share options which are currently exercisable but not in the money. This is because exercise price is above the share price in a G. However, it can be seen that they are only just out of money. In addition, the share price of G is expected to increase and cost savings are expected from further acquisition of the share. It seems therefore that share option would be deemed to be substantive. Since exercising these options would enable C company to obtain 60% shareholding, it can be concluded that C company is able to exercise power over the G company from 1st April X6. So G company should be reclassified from associate to a subsidiary company. From associate to a subsidiary company. It should be accounted for. And now the next requirement, using Exhibit 2, briefly explain how the additional purchase of 18% equity share in a G should be accounted for in the consolidated financial statement of the C company. These will be treated as we have discussed. These will be treated as the controlling right as we have get the control. So the goodwill will be calculated. So the goodwill will be calculated. They will be considered in the calculation of the goodwill. So it is necessary for the calculation of the goodwill okay, the answer of briefly explain how the additional purchase of 18% equity share in a G should be accounted for. They will be measured at the fair value of the consideration. They will be measured at the fair value of the consideration. And whatever the consideration, it is not mentioned in exhibit number 2, but they will be measured at the fair value of the consideration at 31st March X6 when they have acquired further 18% share, whatever the fair value. On that day, they will be measured at the fair value of the consideration given to acquire these 18% share. For this requirement, this will be the answer and it will be having 2 marks. Now, requirement C, using Exhibit 3, explain the calculations, how the fair value of the G non-current asset should be measured at 31st March X6, including any deferred tax adjustments. So now we have the exhibit which is relating to fair value of the net assets of the G company when we get the control on 31st March X6. But before I discuss this adjustment, let me tell you one more thing. This is the step acquisition. As you know, it is a step acquisition. The associate company has become our subsidiary company. Now, the carrying value of the associate company was 118.6 million. Now, when it becomes the subsidiary company, this investment in associate will be taken at fair value for the purpose of the calculation of the goodwill. and any difference between the carrying value of the associate and the fair value will be recorded in profit and loss account or group retained earning. Okay. So C company has, now I am reading the exhibit 3. C company has equity interest in several companies. Goodwill relating to the companies other than G has been impaired. The director of the C have prepared the draft consolidated financial position at 31st March X6 in exhibit 4. Investment in G have been stated at cost 100 and 66 billion. 66 billion is the further consideration which has been given to acquire 18%. Okay. And this 166 million has been has been, if you're looking at the given consolidated financial position, this is a pre-populated spreadsheet. They have carried the investment in green at 100 and further investment at 66. So they're talking about this. Now, in place of these values, uh, as I told you that 18.6 will be added here, and this 118.6 will be eliminated here as well when we get the control, because this will be treated as a part of the purchase consideration at fair value. So coming back to the exhibit 4 again, exhibit 3 again, so 166, and the net asset of the G have been included at their carrying amount from individual financial statement. The equity of the G also been included as the balancing figure, and goodwill has not been calculated. The consideration for further 18% of the equity share of the G at 31st March X6 is included in a consolidated SOFP at the cash price of 66, and the fair value of the original 30% equity share in a G is 127. Fair value is 127. 118.6 is the carrying value and 127 is the fair value. So it will be taken at fair value to calculate the goodwill. And the carrying amount of the net asset of the G company at 31st March X6 as follow: current asset, deferred tax liability, non-current asset, and current liabilities. Included within the non-current asset some land. The carrying amount of this land at 31st March X6 in a G individual financial statement was 50 million, but the fair value assessed to be 60 million. And current asset includes some finished good at the cost of 84 million, who has the fair value of 131 million. On 31st March X6, the director of the C also identified G had internally generated database of a customer who were likely to be interested in purchasing of their product, although there were no contractual or legal right associated with the database. A professional expert has estimated that competitor of the G would be prepared to pay 5 million for the database. Green did not recognize the database as an asset in its individual financial statement. Tax rate is 20%, and the tax base of the asset and liability is based on their carrying amount in the individual financial statement. C company measure the NCI at the proportionate share of the fair value of the net asset. Now, the requirement of relating to this exhibit, that how the value of the current and non-current asset should be determined. So it should be determined at fair value. Whether it is current asset or non-current asset, it should be measured at fair value. So in non-current asset, they have a carrying amount of 355, which include a land who has a carrying amount of 50 but fair value of 60. So obviously 10 million fair value adjustment will be required in a non-current asset. Similarly, is inventory included at 84, but the fair value is 131. So it should be taken at fair value. So 47 uh, should be adjusted in the current asset, and they have some internally generated intangible asset which has a fair value of 5 million. That 5 million should also be considered as an intangible asset. So they will be taken at fair value. So if we consider all these things, the fair value of the net assets at the date of acquisition will be 355 plus 10 plus 5, 10 land, 5 intangible asset plus 214 plus 47 inventory fair value adjustment and minus 16 minus 205. So the fair value of the net asset at the date of acquisition is 410, but the carrying value is 348. Sorry, carrying value is in a consolidated book is 410, but the tax base is equals to the carrying value in the individual account, which is 348, and this will give rise to a taxable temporary difference of 62. And on that 62, a 20% deferred tax liability arise. Tax rate is 20%. So 12.4 a deferred tax liability, and it will be recognized by debiting net asset at the acquisition date and by crediting the deferred tax liability in a balance sheet by 12.4. So when I will recognize the 12.4 deferred tax liability, the fair value of the net assets will become at the date of acquisition equal to 397.6 million. 397.6 million. And if you talk about the calculation of the goodwill will be equals to investment in which 66 million cash is paid. Previous investment will be taken at fair value of the green company, which is 127, and NCI will be taken at the proportionate share, and proportionate share will be 397.6 into 52%. 52% is the NCI, so it will be 206.75. So it will give you a total of 66 plus 127 plus 206.75, 399.75, and fair value of the net asset is 397.6. So if you take the difference, 397.6, the goodwill at the date of acquisition will be 2.75, need to be recorded. 2.75. So this is how we need to consider the fair value of the asset, non-current asset and current asset, and including the deferred tax liability. Okay, so that means in a consolidated SOFP, this 118.6 will be added here, and then 118.6 will be minus, and the fair value change of 118.6 and between 127 will be reported in group retained earning. Goodwill of 2.75 will be recognized on this acquisition. This 66 will be eliminated. A deferred tax liability of 12.4 will be recognized, and fair value adjustment in the land of 10, intangible asset of 5, and inventory in a current asset of 47 will be adjusted in the pre-populated balance sheet here. And now this is the answer of the exhibit number 3. It is necessary for the calculation of the goodwill that C company measure the identifiable asset required and liability assumed at their acquisition date at fair value. IFRS 3 fair value measurement should be considered in assessment of the fair value. It has been identified the fair value of the land is 10 million above the carrying amount. The valuation should be representative of the amount which market participant would willing to sell an asset or transfer the liability. So increase in a fair value of 10 million will create additional taxable temporary difference, part of the 62, and similar, and it will give you rise to 2%. So 2 million deferred tax liability will arise on a land, uh, and so 10 million will be added in a land, 2 million will be added in liability. So the net fair value adjustment is 8 million. It has been considered in my calculation. Similarly, inventory will be increased by 47. It will give rise to a taxable temporary difference of 47, on which 9.4 million deferred tax liability will be calculated. So 2 plus 9.4, 11.4. Similarly, the database will be recorded at 5 million, which will give rise to a taxable temporary difference of 5, which will result increase in a deferred tax liability of additional 1 million. So 12.4 million deferred tax liability arise. 47, 5, and 10 will be adjusted in a fair value of the non-current asset, intangible asset, and inventory in a current assets. And this is how the goodwill will be calculated. 348 plus 10 plus 47 plus 5, 2, 9.4, and 1, 12.4 is a deferred tax liability. So 397.6 is the fair value of the net assets. 206.8 is a rounded figure, 52%. So the resulting goodwill is 2.2 million. 2.2 million need to be reported. Got it? And these things will be adjusted in this pre-populated spreadsheet. But due to some technical reason, it should be available in a spreadsheet, but due to some reason at the moment on the website that is not available here, so I am unable to perform the calculation in a pre-populated spreadsheet. But the adjustment will be that I will be recognizing the goodwill, I will be recognizing the 18.6 million post-acquisition reserve of the associate, then I will be de-recognizing the associate and recognizing the associate at fair value 127 as a part of the consideration while calculating the goodwill, and resulting gain on buying the fair value I will be reporting in group retained earning. These will be done here. Okay. Any question? Any questions, students? Okay. Just a minute. I'm just trying to get the spreadsheet of this question. Okay, in a meanwhile, I'm giving you a task. I have shared this notes with you. Have you download the notes? Can you confirm? Okay. So I'm giving you a task that before coming in a class tomorrow, kindly read the page which I'm giving you from page number 20, starting from page number 22, from page number 20 to page number 45. Page number 22, page number 20, 44. 20 to 44. I'm giving you a task that kindly read these pages before coming in the next class. Okay? Okay, students. So now I will see you tomorrow. And in tomorrow class, we will be doing again some practice question on group accounts. Especially, I will be focusing on foreign subsidiaries and the consolidated cash flow statement. And maybe on question number two, I will start work tomorrow in a tomorrow class. So see you tomorrow uh, on the same time. Okay. So goodbye and take care.